Hey everyone, welcome back. Today we're diving into credit default swaps or CDS. Not sure what they are? Don't worry, I got you covered. Let's start with the basics. A credit default swap or CDS is a financial contract to swap credit risk with another investor. It's like insurance for bonds or loans. If you're worried the borrower might default, you can buy a CDS. It's like paying a premium to insure against that risk. How does a CDS work? Here's how. There are two parties in a CDS, the buyer and the seller. The buyer pays a regular fee to the seller. The seller compensates the buyer if a credit event happens. For example, you have a bond from company X and worry they might default. You buy a CDS to protect yourself. If company X defaults, the seller compensates you. What exactly is a credit event? Good question. A credit event triggers the CDS, bankruptcy. If the company goes bankrupt, failure to pay if the company doesn't make a payment. Debt restructuring, when the company changes debt terms. When these events happen, the CDS compensates the buyer. CDS contracts typically have a term of 1 to 10 years. During that time, the buyer makes payments and the seller covers any credit events. If nothing happens, the CDS expires and the contract ends. Now, let's talk about settlement. How the payment works if a credit event happens. There are two ways a CDS can settle. Physical settlement. The buyer delivers defaulted bonds, and the seller pays the full face value. Cash settlement, the seller pays the difference between the bond's original value and its reduced market value. Cash settlement is faster and simpler. Let's get into the pros and cons of credit default swaps. Pros: risk management. CDS helps investors manage credit risk, like a safety net. Speculation. Investors can use CDS to bet on whether a company will default, even if they don't own any bonds. Liquidity. CDS adds liquidity to the market by creating more trading opportunities. Cons: complexity. These instruments can be hard to understand, especially for regular investors. Counterparty risk. The seller might not be able to pay if too many defaults happen. Speculative risk. Using CDS to bet on defaults can lead to risky market behavior, as seen in the 2008 crisis. We can't talk about CDS without mentioning the 2008 financial crisis. CDS played a huge role in the collapse. Banks and investors used CDS to speculate on risky mortgage-backed securities. When the housing market collapsed, sellers like AIG couldn't cover the losses. This led to failing institutions, massive bailouts, and the worst economic crisis since the Great Depression. So, yeah, CDS can be dangerous if misused. So, to sum it all up, credit default swaps can be powerful tools for managing risk. But they also come with big risks if used irresponsibly. They helped trigger the 2008 crisis, but they're still in use today. If you're looking to invest, make sure you understand what you're getting into. That's all for today, folks. If you found this video helpful, don't forget to hit the like button and subscribe. Until next time, take care and stay savvy.